Ladies and gentlemen, friends of the channel, today I want to take you deep into the heart of what I call the September warning, a powerful shift unfolding in gold and silver markets that could reshape how we think about value, risk, and opportunity. The markets are sending signals that are impossible to ignore, and anyone paying attention can feel the shift unfolding in real time. Gold and silver aren't merely reacting to short-term noise. They're recalibrating to a world where uncertainty is no longer episodic, it's structural. When you see simultaneous strength in monetary metals and rising demand from both investors and industrial sectors, it's a sign that capital is preparing for a new regime. What's happening this September is not a ripple. It's the early stage of a realignment that has been building for years, but is finally breaking into full view. The first element driving this shift is the global retreat from confidence in traditional financial anchors. When bond markets become volatile, currencies weaken, and central banks send mixed signals, investors don't wait for clarity, they move preemptively toward assets that transcend policy cycles. Gold, historically the cleanest expression of fear and foresight, is now being accumulated not just as a hedge, but as a core strategic allocation. This isn't panic. This is positioning. When capital moves with this much intent, it implies expectation that the old frameworks guiding markets may no longer reliably define value or stability. Silver, meanwhile, is undergoing a transformation that is even more profound. It's no longer just the cheaper gold trade or the secondary safe haven. It is becoming the metal of the future, essential to energy transition, electrification, battery technology, and the next generation of industrial infrastructure. The supply side cannot easily expand to match this growing demand. Mines are aging, ore grades are falling, and new projects take years to come online. So when investment demand accelerates on top of this structural deficit, the effect is magnified. Silver's volatility becomes its opportunity. It's a market that doesn't move gradually, it leaps. What we're witnessing this month is the intersection of monetary fear and technological necessity. That combination rarely appears together, and when it does, it tends to reshape market cycles. This is why both metals are behaving with such strength, even as macro data remains uncertain. Investors aren't waiting for confirmation from policymakers. They're reading the direction of the world itself. And the world is signaling that inflation may be more persistent, that geopolitical tensions may escalate rather than ease, and that currencies may weaken before they strengthen. Metals respond to environments like this with precision. The key question now is not whether gold and silver will move, they already have. The real question is what this shift tells us about the broader trajectory of the economy. When safe havens rise while equities wobble and bonds fail to provide meaningful real returns, it's a sign of transition. Markets are searching for reliability in a landscape where fewer assets can offer it. Gold provides that stability through monetary history. Silver provides it through future necessity. This September, the move we are seeing is not a reaction to a headline or a single event. It's the culmination of a slow, steady buildup, finally crossing a critical threshold. These metals are recalibrating to reflect a world adjusting to new priorities: resilience, independence, and tangible value. When liquidity seeks assets with timeless credibility and irreplaceable utility, gold and silver rise together not by coincidence, but by design. The shift has already begun. The question now is who will recognize it early, who will understand the magnitude, and who will position themselves before the next phase accelerates. Something significant is happening beneath the surface, and for those watching closely, the signs are unmistakable. Markets don't shout, they whisper before they roar, and the whisper right now is a clear indication that gold and silver are entering a decisive reversal phase. This isn't just a technical correction, it's a psychological shift, a recalibration in expectations, and a rebalancing of capital after months of pressure building inside the system. What we're seeing is the early formation of a new trend, triggered not by fear, but by the market's anticipation of what comes next. When an asset has a powerful rally driven by macro stress, safe haven flows, and speculative enthusiasm, it eventually reaches a point where momentum alone cannot sustain the move. Gold and silver have been in that pocket, overextended, technically stretched, and pricing in perfection. Markets rarely tolerate perfection for long. As soon as investors sense that conditions are changing or that valuations are ahead of fundamentals, money begins to reposition. That's what's happening right now. We're seeing signs of distribution, where heavy hands are trimming exposure and lighter hands are entering at the top. This pattern doesn't signal weakness, it signals transition. The most overlooked factor driving this reversal is how rapidly macro expectations are shifting. Inflation data is moderating in pockets, rate cut expectations are adjusting, and currency markets are stabilizing in ways that reduce the immediate urgency for panic buying. When uncertainty eases even slightly, safe haven demand cools and metals respond. But the deeper insight here is that the long-term case for gold and silver hasn't weakened at all. The reversal we're witnessing is not the end of the story, it's a necessary reset, a recharging phase before the next meaningful move. Markets breathe in cycles, and this is one of those breaths. Silver, more than gold, is showing its true nature during this phase. It's incredibly sensitive to liquidity flows and industrial sentiment. When optimism rises in global manufacturing or equities, capital rotates temporarily away from metals. But silver's structural imbalance, the convergence of rising industrial demand with limited new supply, hasn't changed. If anything, this reset creates a healthier foundation. Silver rallies that begin with strong industrial fundamentals tend to travel farther and more sustainably than those powered by fear alone. That's why this reversal shouldn't be viewed as an ending, but as an adjustment that strengthens the long-term trajectory. Gold's reversal is equally instructive. Historically, gold consolidates after every major upside surge, forming new support levels that reflect changing global priorities. What markets are doing now is reassessing risk, redefining valuations, and preparing for the next phase of central bank policy. Gold is extraordinarily sensitive to real interest rates, and even small shifts in expectations can trigger volatility. But as policymakers signal ambiguity, as global debt rises, and as geopolitical tensions simmer, gold remains the anchor investors return to. This pullback simply reminds us that even the strongest safe haven assets need periodic recalibration to maintain sustainable trends. What truly matters in moments like this is understanding the psychology of markets. Most investors react emotionally to reversals. They assume that strength is ending or that opportunity has passed. But the most transformative moves in history often emerge after a correction, not before. A reversal is not a message of decline, it's a message of preparation. The market is absorbing excess, clearing speculative froth, and building the structure required for the next leg upward. That is how durable trends form. This September, the reversal we are witnessing in gold and silver is not a warning to retreat. It is an invitation to observe more deeply, think more strategically, and understand that volatility is not a threat but a signal. The system is adjusting, not collapsing. The trend is resetting, not ending. And when the dust settles, the assets with the clearest long-term value, the ones rooted in scarcity, utility, and global trust, will reassert themselves with even greater force. Those who recognize this phase for what it truly is will be positioned ahead of the next acceleration, not behind it. Something remarkable is unfolding in the precious metals markets, and it's happening with a speed and intensity that even seasoned investors weren't fully prepared for. When markets begin to change forever, they don't do it quietly. They send signals, create anomalies, and defy the historical playbook. That's exactly what we're seeing now with gold and silver. The shift is not cyclical, it's structural. It's the kind of transition that tells us the world is entering a new financial era, one defined by scarcity, technological transformation, and a deep reevaluation of what real value actually means. Gold, long understood as the world's monetary anchor, is no longer moving simply because of inflation or geopolitical tension. Those factors matter, yes, but something deeper is driving this moment. Global monetary systems are evolving, currencies are under pressure, and central banks, which historically buy at the margins, are accumulating gold at levels that suggest preparation, not preservation. When institutions that understand macro risk better than anyone quietly stockpile the same asset, it signals a structural shift. It means the world is bracing for a future where traditional monetary mechanisms may not provide the reliability they once did. Silver's transformation is even more extraordinary. For decades, silver was treated as gold's shadow, a follower, not a leader, but that narrative is ending. Silver now sits at the center of the most important industrial revolutions of our time: renewable energy, electrification, advanced computing, and next generation manufacturing. Its use in solar panels has exploded. Its necessity in electric vehicles, grid infrastructure, and medical technology continues to rise, and here's the challenge: supply isn't keeping up. Mines are aging, investment in new production is limited, and the structural deficit is widening. This isn't a temporary imbalance. It's a long-term constraint that fundamentally alters silver's pricing power. The shock happening this September comes from the convergence of monetary demand and industrial necessity. These two forces typically move in separate cycles, but this time they're colliding. Safe haven flows are increasing at the exact moment that industrial demand is accelerating. When that happens in a market already facing supply limitations, the entire pricing landscape can shift dramatically and permanently. This is the moment when silver stops behaving like a commodity and starts acting like a strategic resource. Markets evolve before narratives do. You can see it in the data, the behavior of institutional investors, and the structural imbalances deepening behind the scenes. But the broader public usually recognizes the shift only when prices move sharply. That's why this phase is so critical. We're in the early innings of a long-term transformation, but the market is only beginning to price it in. Gold is signaling a loss of faith in monetary stability. Silver is signaling the emergence of a new industrial age. These aren't isolated movements. They're reflections of a world transitioning toward a different economic architecture. Another layer driving this change is the dynamic between technology and scarcity. As innovation accelerates, the need for metals with specific properties, conductivity, durability, purity becomes non-negotiable. Silver fits into that category perfectly. Gold, while less industrial, is the asset that institutions turn to when they sense systemic recalibration. Together, they form a dual signal, one about the future of energy and technology, the other about the future of money and trust. When these signals align, markets don't just shift, they transform. What begins as a price rally evolves into a structural realignment. And once that transformation begins, it rarely reverses. This September, gold and silver are telling us that a new era is coming, one where scarcity and credibility become the central pillars of value. Investors who recognize this won't just witness the change, they'll benefit from it. The shock isn't the movement you see today. The shock is what this movement represents: a lasting change in how the world values tangible, irreplaceable assets at a time when everything else feels increasingly uncertain. The signals emerging from the precious metals market this September are unlike anything we've seen in recent cycles. Gold and silver are not just reacting to the news of the moment, they're responding to a deeper structural shift that has been building quietly beneath the surface. the kind of shift that doesn't simply move prices, it redefines them. When markets begin to behave this way, it usually means one thing: the system is preparing for a reset, not a collapse, but a rebalancing, a recalibration of value, risk, and long-term priorities. Gold is leading this shift with a message that's both subtle and unmistakable. It's rising not because of fear alone, but because investors are recognizing that traditional financial architecture is becoming increasingly strained. Global debt continues to expand far faster than growth. Monetary policy is caught between inflationary pressure and slowing economies, and the world's major currencies are experiencing a level of volatility that used to be reserved for emerging markets. In such an environment, gold becomes more than a hedge, it becomes a benchmark of credibility. When capital flows into gold at moments like this, it signals a broad questioning of the frameworks that once dictated stability. Silver, meanwhile, is telling a different but equally powerful story. It reflects the tension between present uncertainty and future necessity. On one hand, silver is benefiting from the same macro forces pushing gold higher. On the other, it stands at the center of a technological revolution that is increasing its industrial demand at an unprecedented pace. Solar installations, electric vehicles, 5G infrastructure, and high-efficiency electronics all require significant amounts of silver, but while demand surges, supply remains constrained. We're not seeing the kind of mining investment or geological discoveries that could sustainably close this gap. That mismatch between rising need and limited production is one of the most underappreciated forces reshaping the market. The convergence of these narratives, gold as the signal of monetary stress and silver as the signal of technological transformation, is what makes this moment so critical. When safe haven demand and industrial scarcity rise at the same time, the market doesn't simply adjust, it transitions. This is how multi-year secular trends begin. Prices stop responding to short-term catalysts and start reflecting long-term inevitabilities. And that's what we're witnessing now. The strength in both metals is not speculative exuberance, it's strategic repositioning. Another layer driving this shift is the global movement toward de-risking supply chains. Nations and companies are looking for resilience, not efficiency. They're prioritizing security of resources, stability of energy systems, and technological independence. Precious metals, particularly those tied to energy and digital infrastructure, benefit enormously from this transition. Silver, especially, becomes a strategic material rather than a simple commodity. In this context, its value isn't determined by investor sentiment alone, but by its role in the world's next generation economy. At the same time, gold is becoming central to how institutions navigate an increasingly uncertain macro landscape. Central banks are accumulating it aggressively, investors are rebalancing toward it, and long-term capital is treating it not as a defensive tool, but as an offensive one, a way to position for systemic change. The message here is unmistakable. Gold is being revalued for a world where traditional hedges offer diminishing protection. As these forces intensify, the market's behavior makes perfect sense. The shift we're observing is not a temporary reaction. It is a recalibration that could reset how assets are valued, how risk is measured, and how capital flows across borders. Gold and silver are acting as leading indicators of this transition. Their movement is not noise, it's the early signal of a broader repricing of global stability. The warning this September is not about volatility or short-term corrections. It's about understanding the deeper changes underway. Gold and silver are adjusting to a world in transition, a world redefining what it means for an asset to be scarce, essential, and trustworthy. Those who recognize the magnitude of this moment will understand that the shift happening now could reshape everything.